welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Matthieu Jobbe-Duval returns to review the markets in crypto RFQ. I'll be talking to Cynthia Wu and Daniel Yan from Bit.com about the crypto derivatives markets in Asia. And Teana looks at DeFi on Bitcoin with Gabriel Kerman from IOV Labs and Manu Ferrari from Money on Chain. First, a look at this week's blockchain industry news. The big news this week came from the U.S. Office of the Comptroller of the Currency when they announced that national banks and federal savings associations will be able to hold reserve funds for one-to-one backed custodial stablecoins. Coming on the back of the news that Kraken has become the first U.S. crypto firm to obtain a full banking license out of Wyoming, the long-standing battle between digital assets and traditional firms may finally be starting to ease up. While the European Central Bank was sounding a more cautious tone in its own stablecoin report last week, MasterCard signaled its intent to move with the times when it announced the release of a testing platform for CBDCs, noting that 80% of central banks are looking at digital currencies, according to a survey for the Bank for International Settlements. With crypto Twitter's excitement over MicroStrategy's purchase of more Bitcoin last week still in the air, a survey by crypto insurance company Evertas indicated that more institutional support may be coming down the pike. 90% of institutional respondents in the UK and the US, with a collective AUM of 78 billion, said they expect to see some increase in crypto holdings in the next 5 years. A mine of a different type unknowingly became blockchain-enabled this week when Engine, an Ethereum-based platform designed to service the online gaming industry, released a plugin that allows Minecraft players to import NFT versions of the in-game items into the virtual world. And finally, after the DeFi rise this summer, over 1 billion worth of Bitcoin has been tokenized on Ethereum, up from 7 million in January, showing how assets can live on more than one blockchain at once, even if just temporarily. That's the news this week. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ.
Thanks, Nisa. I'm back again this week with Matthieu Jobbe-Duval from CoinList. Hey, Matt. Thanks for coming back.
How are you, Teana?
I'm brilliant. It's great to see you.
Good to see you.
So what's been happening in the markets this week?
So a bit of a doozy. Things are not really going anywhere at the moment. So Bitcoin moved from 12,000 to 10.5. It's been staying there for about 10 days now. Implied vol super low. 40%, which is kind of the low end of the range. Every time we go towards 40 or the high 30s, that's when we have a breakout. So it's going to be interesting to keep an eye on that. Calls and puts are above the at the money. So it kind of feels like the market is not too sure which direction we're headed, but they want to buy protection either way. In the broader macro market, we are kind of, between that last run up to the election, the S&P came up from the highs at 3,300 right now. Again, a lot of uncertainty. It kind of feels like the market is slowly catching up to the fact that COVID is not going away. The UK is locking down again. Paris is, the masks are back. So the wishful thinking that the market has displayed in the last 6 months is or could slowly be unwound. Is it going to be a slow unwind or a cliff jump? We'll see soon enough.
Yeah, we will indeed. And so DeFi markets, been very, very interesting the last couple of weeks. What's been going on? We were talking earlier about liquidity pools and how those work. Tell us a little bit about that.
Yeah, absolutely. So liquidity pools is a really interesting experiment that has started in DeFi. So a liquidity pool is nothing more than a pile of asset A, a pile of asset B, and they are made available to a trader. If you want to trade in that pool, you have to bring asset A to get asset B, or vice versa.
Right.
So how come that system has never been used in centralized exchanges? Well, it's because centralized exchanges don't need to. Centralized exchanges have low latency, they have feature-rich environments and UI, so they can have the full order book, the continuous limit order book, the club. Now, having a limit order book in a DEX, as in on-chain, is close to impossible at the moment on layer one. Why? Because adding an order means paying transaction fees. Removing an order means paying transaction fees and slowness, of course. And it's just, the whole thing is just not meant to be on a layer one, especially not on ETH. So some protocols have tried, such as 0x, to have an order book off-chain and to only bring the trades on-chain. A few things have been tested, but really what people ended up realizing in the decentralized world is that users don't really want all that feature richness of an exchange. They just want the ability to trade A for B at a fair market price quickly and trustlessly. And that is what liquidity pools are doing. Liquidity pools are saying, okay, I've got an ETH USD pool. It's always 2 assets only. ETH USD pool, you can see it as the trading pair. If you bring A, then you get B. If you bring B, you get A at the ratio of the pool. So for example, if you're in your pool, you have 1 ETH for 400 USDC, it means that the implied price of that pool is 400 USDC per ETH. And so if you want to buy 0.01 ETH, you're going to take away 0.01 ETH from the pool. It's going to go from 1 to 0.99. And you are going to have to pay 400 ETH. So the pool is going to go to essentially as 0.1, so 440 USDC. So from 1 and 400 to 0.99, 440, and the price stays balanced that way. So one thing that's very interesting when you look at those pools, you think, okay, so the bigger the pool, the harder it is for the price to move. It's actually something I read recently on Twitter. It's the wrong way to think of these pools. These pools are really a pile of assets, and those assets then are connected to global prices, the Coinbase, the Binance, and the Kraken price, by the play of arbitrageurs. So if ETH goes from 400 to 800 on, let's say, a centralized exchange on Binance, for example, all of a sudden, that 1 ETH that is there for 400 USDC is ripe for the taking. It's a very cheap ETH. So someone is going to come in and, for example, buy 0.5 ETH for 200 USDC and bring back that pool into balance and change the price of the assets inside that pool. So the pools are always connecting to the global prices because hundreds of arbitrageurs are constantly looking for an opportunity.
So what happens when the asset prices in the pool begin to drop?
So that's something really fun about the liquidity pool itself, is that because it's a completely different setup, you are still looking at market makers doing the work of connecting the pools into the global prices, but anybody can become a liquidity provider. Today, if I connect on Coinbase and I want to be a market maker on Coinbase, chances are I need to have a solid bot, right? That shows bid and offers, refresh, in like hundreds of seconds, pull them, put them back in. It's a job, right? So market makers is a real technical function. For a liquidity pool, it's completely different. I can be anybody and come in and bring the 2 assets in the pool. I'm a liquidity provider. Now, what people don't necessarily realize is that by participating in such pools, they are actually entering a negative gamma position. Let me explain. Yes. So negative gamma is a term that comes from the option world. And negative gamma means at what rate your delta position is changing. So if we go back to our pool of ETH USDC, let's say I'm already long ETH and already long some USDC. Okay, I've got an equal position, 50-50. I put my ETH and my USDC in the pool. Now the price of ETH rallies, right? So as we said, when the pool always connects to the international price, to the global price. So if the price of ETH rallies, essentially I'm going to have more USDC in the pool and less ETH. Right? Yeah. That's just by the natural function of the liquidity pool. So as a liquidity provider, I came in and offered 1 and 400. If I want to take out the liquidity of that pool, I'm going to get way less ETH now and more USDC, meaning I've been selling my ETH on the way up, right? So when the price rallies and I'm losing a position, it's called negative gamma. On the way down, it's exactly the same thing. If the price of ETH has tanked from 400 to 100, for example, and I want to take out my liquidity, I'm going to end up with a lot more ETH than I put in. So I'm getting longer an asset that's coming down, again, a negative gamma position. So usually when you're negative gamma in option world, which means being short an option, essentially, you are long theta, you're long the time decay. That theta in liquidity pool, in the world of liquidity pools is realized by trading fees. As a liquidity provider, I earn a portion of the trading fees. Now, are those trading fees paying for the negative gamma I'm in? Well, as long as, like any negative gamma position, as long as the spot price reverts to the mean, I'm good, right? If the price goes up, then down, everything's fine for me. I've collected trading fees and the price hasn't changed. So my liquidity is worth the same in asset terms.
Yeah.
But if the price goes down dramatically, what happens? Exactly what has been going on recently, and that is what has put a lot of fuel on the fire of ETH price going from 440 to 340 right now, is that when the price of an asset starts to go down, everybody gets longer that asset, because everybody who's been in that pool gets longer ETH. They realize that, what do? They need to sell ETH, right? Because they're getting extremely long something that's falling like a rock. They don't necessarily wanted that position to start with, right? They just participated in that pool because they wanted their free token, right?
Yep.
Now they get super long ETH. What do they need to do? They need to dump it because they don't want so much of it, right? I had a nice and balanced ETH USDC position. Now I'm long all of that ETH. I need to sell it. So that has triggered a lot of liquidations and very dramatic price movements. ETH was one thing, but all the other DeFi tokens, just like CRV, LEND, comp, even all those that were used in liquidity pools, remember, not for the purpose of trading, but really for the purpose of getting free token airdropped. Wow. Those have also seen very dramatic price falls, not because of leverage. This is not a function of people who are overly leveraged, like what we see on, for example, the BitMax perp swap or the futures. This is not leverage. This is pure negative gamma that is given to the users and to people who really don't necessarily understand what a negative gamma position is.
I was just going to say that. Do they even understand that that's the position that they're in until it starts to move the opposite direction?
They understand once they try to take out the liquidity that they put in, and they see, oh, wait a minute, the balance of these assets is not what I put in originally. So once they see that, in DeFi, they call that impermanent loss, which is a very poetic way to say, if the market mean reverts, the loss that you experience on the movement up or down will be not permanent if the price catches back to the mean. But one thing crypto does is not reverting to the mean, especially for smaller tokens. So the loss can be very, very permanent in that if you don't hedge that negative gamma by either doing options or just buying back the position that you're losing when the market moves, which completely defeats the purpose of being in the negative gamma position in the first place. Because if you trade, then you piss away, excuse my French, all the trading fees that you're collecting in the pool, you pay them by trading yourself to hedge your position. So you're just short negative gamma now with nothing else to pay you for. Clearly, users have not, well assessed that in a very quiet market like what we had in August. That's fine. When things start to come off, we saw that it just added a ton of fuel to the fire, and it might become a mainstay of ETH price dynamics.
Indeed. Well, and some of the more volatile things that have happened, the sushi swap saga, as we like to call it, all these things are an experiment, right? And so we have people playing with some of these protocols and services that don't necessarily have the same trading background or that fundamental market knowledge, that are kind of figuring things out as they go, which I think also kind of contributes to the dynamics a little bit.
For sure. And, the panic is there also because it's not necessarily institutional players being involved, but retail players. As you said, the experiments are extremely valuable. It's great. A liquidity pool a few years ago would have been unthinkable because what's the point? It clearly fills a void. However, the mania, really the popularity of those pools for the sake of receiving the new hot token is not necessarily an overall positive for the space, especially when volatility comes back. And it means a lot of P&L hits for a lot of people who don't need that, really.
Right. Indeed. Well, it's always a pleasure to have you. I always learn something when we chat. So thank you very much for coming back. And we'll see you in a couple weeks. All right.
See you in a few weeks. Bye-bye.
Back to you, Nisa.
With the crypto derivatives markets maturing and CME launching options contracts for Bitcoin earlier this year, retail demand for crypto options is also picking up, especially in the APAC region. Following the recent launch of their Bit.com derivatives trading venue, I spoke to Cynthia Wu and Daniel Yan from Bitmain-backed Matrixport to find out more about the state of crypto trading in the Asian markets. Welcome, Cynthia and Dan. I'm delighted to be with you both today. Thank you for joining us.
Thank you, Nisa, for inviting us on the show.
So tell us a little bit more about Bit.com and Matrixport and its connection with Bitmain.
Yeah. Cynthia, you want to take this part?
Sure. So Matrixport, we are a spin-off from Bitmain in February last year. So Dan and myself, before we started Matrixport together with Jihan and John, we actually were working at Bitmain, building some of the building blocks that lead to our venture into Matrixport. That, of course, they already built a very successful business at Bitmain and built that into the largest Bitcoin mining equipment manufacturer. And they do see that the industry is evolving fast, and with more people like holding Bitcoin and other type of mined crypto assets, they're actually looking for a more better service on the crypto financial crypto finance side. So basically, we believe this is going to be a market that is going to see exponential growth. So in end of 2018, we basically made that decision that we want to properly develop this part of the business, which is crypto financial services. So we then decided that we want to spin off and have a full focus on this part of the new business. So when we spin off from Bitmain, we had around 70 people that we brought over from Bitmain. Of course, the team is much, much bigger now. We are 165 people globally, globally headquartered in Singapore and having offices in Hong Kong, in Switzerland, in Moscow. And some have developed a team in China as well.
And you're primarily targeting professional customers. How deep does your liquidity go, Dan?
Yeah, thank you for the question. First of all, you're right. So at this moment, we're more focused on the professional customers. We do have strategy for retailers actually in the months to come, but I would say it's pretty good for a new exchange, to be honest. So on the future side, we generally have $6 to $10 million of depths on the order book. And for options, we have roughly 250 strikes. And on each strike, normally we have order book depths of $1 million. So it has been a good amount of liquidity per our customers, and that's also why we're growing substantially in the past 1 month.
And how sophisticated are you seeing these users becoming with options versus futures?
Right. Well, I think it's really, I think you're asking about retail, right? Not professional.
Yeah,
which
for retail.
Retail customer. Yeah. I think it's the future product is much more natural for them because it is just a leveraged spot to them, right? If just thinking from retail's perspective, it's a linear transformation. But options, given the non-linearity, it can get a little confusing. So at this moment, I think not only with us, with everyone, all the retail products in the cryptocurrency world, I think most of the retail customers, they understand how to use structured products to earn money, which is embedded with options, but it's generally difficult for them to understand how to just use option as a products to trade and how to trade it. It's generally very few people know. So that is definitely a big workload we need to focus on in the next year in part of our retail strategy. That is, we need to provide quality content to help retailers understand how to use this product.
And how far out in terms of expiry do you go? How liquid are the contracts?
Yeah, so I think, so our contracts go from 1 day options to roughly 3 months options. So liquidity mostly resides within 1 month.
So Cynthia, with your ties to Bitmain and miners becoming ever more sophisticated in their hedging strategies, what are you seeing from that part of the market?
Yeah, sure. As we are spin-off from Bitmain and quite familiar with mining communities globally, I mean, they are part of a very important part of our clientele. I would say that in the crypto mining space, all the miners are evolving really fast. I mean, I would say that evolve at a light speed compared to some traditional commodity miners. So not only in mining operations, but also in terms of their financial savviness. A lot of the miners, both from China and in the West, are picking up the idea of hedging and risk management pretty fast in the past 1 year, especially in the past 1 year. I think after the March 12th, when market crashed, a lot of the miners actually had a very hard hit. And they started to realize the importance to protect against the downside risk. So they start to adopt that mindset that they don't mind paying a small cost to buy the insurance, and they understand the importance to be in the game for the long term, and that which means that they need hedging. So we see a lot of that coming to the market after this year. A lot of that flows. I would say in Asia, like the miners like to buy straight put options, sell covered calls, or do both at the same time. And like for example, for us, we have a product called dual currency product, basically help the miners to sell covered calls and puts to collect the premium. I think that's become one of the very popular products. And we do see a lot of miners make use of that as a way to hedge. And also we provide zero cost loan. Basically it provides, no cost, zero interest lending to the miners, but they have to give up certain price upside beyond certain exercise price. And that become also very popular. I think Asia really, there's a big room to grow for the structured product, and the miners, they are understanding it pretty fast and well.
Do you also offer advisory or OTC services?
Yeah, we do offer OTC services from the very beginning. So I think actually Dan built that part of the business up when we were still at Bitmain. And when we spin off, of course, we took that part of the services into Matrixport and offer it as one of our basic services. So on the OTC part is pretty steady business for us. I think we're trading around 100 million US dollar notionals on the spot side. We're currently not doing advisory as a business, but as part of our structured solutions and hedging services, we do share our professional knowledges and help advise our clients on what hedging strategies would work better for them for their scenarios whenever they need. But it's not.
So Dan, in Asia, SBI has been heavily investing in the space for a while now. Are there any other major financial services firms that are entering the market?
Right. So yeah, SBI has been active. I think in Asia, honestly, it's mainly the crypto native companies that's been taking the spotlight. There's also companies in Hong Kong, Singapore that have traditional finance background. They're founding new, funds, quantitative trading funds. But in general, it's been evolving, but not that we have seen a big company like that yet.
And what do you think?
Yeah, I will say, just to add up to Dan's comment. Yeah, I think that's right. In terms of crypto financial services, we see definitely traditional hedge fund coming to crypto and start their crypto branch. We see some family offices tip their toes into this asset class. We see proprietary trading desks trading, actually already very actively trading in this space or market making. But in terms of those internet giants or like traditional financial service provider, I think SBI, as you mentioned, is one. The other players, I think a lot of them are not yet in crypto finance, but they are in blockchain technologies. So like South Korea internet company Kakao, they have public blockchain Clayton. And in China, the Baidu, Alibaba, Tencent, they all have their enterprise blockchain solutions. And in Singapore, and I think last month or this month, SGX, Singapore Exchange, they partners with HSBC and Temasek Holding to issue digitize the whole end-to-end bond insurance process on DLT. And I think in China, there's some traditional conglomerates that get into crypto, and they offer their crypto franchise Hashkey. And the other involvement are mainly from the private equity and the VC side. You see a lot of banks, their private equity arm are definitely getting more active in investing into crypto-related companies. Yeah.
Do you see any impact from the digital yuan on the overall market?
Overall market, you mean, just to be specific, you mean on crypto itself, or?
Yes. Yes, and also China's stance on trading crypto.
Sure, I can talk about that. I think in China, the crypto, is always defined as a liquid asset and a virtual commodity, but not a money. So that's very important difference compared to some other jurisdictions, which I think tells a lot about the stance of the Chinese government. I would say that China has not prohibited the crypto outright, but and actually in November last year, the authority of Chinese government actually said that Bitcoin mining will not be an illegal industry in the country, which I think gives a relief on people who worry about the sustainability of Bitcoin mining in China. But China prohibits token funding and also trading platforms from engaging in exchange business between the RMB, the legal tender of the country, and the cryptocurrencies. So I think that's still going to be the case going forward, because there's capital control in China. I don't think in the near term there will be any change of policy in that part. Yeah.
And with DeFi being all the rage right now and volumes on DEXs skyrocketing, what do centralized exchanges need to keep their eye on most, and what are your plans in the area?
Sure.
Yeah, Cynthia, you want to take it?
Yeah, sure. DeFi definitely still the spotlight of the year. And we have seen, I think, close to or passing like 10 billion total value locked in the DeFi protocols, which is quite amazing. I think, in the past 2 years, of course, the DeFi already doing a lot of preparation work, but I guess a lot of the DeFi projects themselves didn't expect such an explosive attention this year. It definitely become very, very interesting phenomenon. For us, we've been observing it from the very beginning. Last year we started to pay attention to this area, and this year we have actually been the first centralized platform integrate with Compound before their liquidity mining actually, and then we also offered our liquidity mining as a service, basically, product on our Matrixport app, which we help our users to take all the hassles and help our users to mine liquidities and get a yield higher than normal yield in those DeFi projects. And we've been participating in Curve, in YFV, and some other protocols. We are constantly looking closely and talking with the hottest DeFi projects in the space, trying to offer that as a service on our platform. And I think we're not alone, because you definitely see the top exchanges and centralized platforms in Asia are embracing this trend and trying to incorporate the yield as one of their new feature or product and offer it to their existing users. I think that trend is probably going to carry on.
Thank you so much to both of you for joining us today, and we look forward to more great news coming out of your company.
Thank you very much. Yeah, thank you, Nisa, for having me.
Although much of the recent hype surrounding DeFi has focused on Ethereum-based projects, other networks continue to position themselves in the space. First conceived way back in 2015, Rootstock is a second layer solution designed to merge the benefits of Ethereum smart contract capabilities with the security of the Bitcoin blockchain. Teana was joined this week by Gabriel Kerman from IOV Labs and Manu Ferrari from Money on Chain to find out more about the state of the network and its first dedicated stablecoin platform.
Thanks, Nisa. I'm delighted to be joined today by Manu Ferrari, co-founder of Money on Chain, and Gabriel Kerman, co-founder of RSK and master advocate of IOV Labs. Gentlemen, thank you both so much for joining us today.
Thank you.
Thank you so much, Tina. Pleasure to be here.
Great to have you. So we're going to be discussing DeFi for Bitcoin today. Interesting topic. I think that no one within the industry can have escaped the explosion of interest in what's become known as DeFi, with most of the interest really centering around Ethereum-based projects. Rootstock, or RSK, was conceived way before all of this started. And even before the 2017 ICO bubble. And, I think the vision was, the merging of benefits of Ethereum's smart contract capabilities with the strengthened network effect of the Bitcoin blockchain. So, Gabriel, can we start with you? Can you tell us a little bit more about RSK? Who's the founding team other than yourself, and how did it come about?
Yeah, sure. So we also have Dieguito, Sergio, Adrian, Ruben, and Adrian as part of the founding team. And it's important to understand that RSK was conceived in Latin America. So it has this vision that comes why Bitcoin is so important, right? Before creating RSK, many of us were deeply involved in the Bitcoin community. Sergio was security auditor of the Bitcoin Foundation in the US and Ethereum. Dieguito created the first Bitcoin Center and the most important conference in the whole region with Rodo and Franco. So we were deeply involved in making sure that users and people around Latin America could benefit from Bitcoin, which is so important and so much needed.
Yeah. So where's the project today in terms of its roadmap, and how does IOV Labs fit into it?
Well, so as I was saying, from the beginning, the whole idea of merging the benefits from Bitcoin and Ethereum was to make sure that we could develop a DeFi ecosystem, a financial system that was so efficient and so programmable that could be used by any person around the world. And after almost 5 years in building this, we're quite excited about what's happening and what's going on in the space right now. From a technical standpoint, we reached around 50% of total Bitcoin merge mining securing the RSK blockchain. So this is a huge milestone, and we're always super grateful to all the Bitcoin miners that are also securing smart contracts and enabling DeFi for Bitcoin, because it's them who are providing this security. And also there's a growing, super interesting ecosystem of solutions being built also on the RSK ecosystem that we can also cover. From a technical standpoint, on the RSK team, we've launched the HSM, or hardware secure modules for the two-way peg. And we are in the process of launching the POPEG, which includes the security of the Bitcoin proof of work in the security of the two-way peg. So this is super, super exciting. We also launched the Armadillo security and and an Ethereum bridge with RSK. So now projects such as Chainlink and DAI are also making their tokens available on the RSK ecosystem through this RSK Ethereum bridge, which is quite exciting because basically joins all the community together and all the different projects that are working in the same direction, this providing financial inclusion to the world. So we're super excited about this major projects on the Ethereum ecosystem also making their services available on RSK through the bridge.
Yeah, well, we had Greg DePrisco from the Maker Foundation on the show a few weeks ago to talk a little bit about, DeFi under the premise that money is what underpins any economy. So it could be argued that DAI was an integral to the growth of the entire, DeFi movement. Manuel, can you tell us a little bit more about Money on Chain and your founding team, and how did it come about, and what have you guys released so far?
Well, Money on Chain being found with Max Cajusa, who is one of the other co-founders. Actually, Money on Chain was his idea. He wanted he's an all-time influencer in Argentina, in Bitcoin community, maybe one of the first person who did public talks about Bitcoin in Argentina. So he's a very well-known person here, especially in the Bitcoin. And he thought about building a stablecoin before Tether. And when Tether appeared, he said, well, okay, Tether did it. But he quickly realized that that was not a solution for Bitcoiners because it's a centralized stablecoin. And he thought about the idea of building a decentralized. He waited for someone to do it. No one did it. And he knew Dieguito, the co-founder of RSK, for many years ago. And when RSK appeared, we talked. Actually, I was present there. We talked with Dieguito at early 2018 about building a stablecoin with Bitcoin as collateral. And he told me, actually, we built RSK because of that, because it's the technology needed for enabling a Bitcoin stablecoin. Well, we have the full support from Dieguito and the whole RSK co-founders team, and here we are. The stablecoin is running on RSK. It's the first 100% Bitcoin collateral stablecoin, and it has other things.
So how do the mechanics compare with something like, MakerDAO and DAI? And, how do your leverage tokens work?
Well, it's a completely different financial model behind the smart contracts. It has three main tokens, or three main actors with different use cases. Of course, there is a stablecoin, which is the dollar on chain, which is, as I mentioned, 100% backed by Bitcoin and only Bitcoin. Then we have a token, which is a liquidity token, which is called BPRO. The BPRO is a token which is meant for Bitcoin holders, and it has a little bit of leverage that usually is between 1.05 and 1.20. So it has a free leverage, which is actually something that anyone would like in a token as Bitcoin. If you are bullish on Bitcoin, well, why not get free leverage on a bullish asset? And on top of that, it has what we call a coded income, a passive income. It gets part of the fees of using the platform. Anyone who uses the platform have to pay a very small fee, but that fee, part of that goes to the liquidity provider, which are the BPRO holders, and it gets also part of the governance tokens of the platform are going to get by these token holders. So it has several income sources to be a very interesting token for Bitcoiners. So it's a DeFi token meant for Bitcoin holders, long-term Bitcoin holders.
Yeah.
And the last one is, sorry.
No, please go ahead.
The last one is what we call the BTCX, which is a completely leveraged token. It's a position you set inside the platform, and it gives you a 2x long position on Bitcoin. So it's, for example, that token and the BPRO doesn't exist in other DeFi platform, not in Ethereum, not anywhere. It's a different model. And this is leveraged Bitcoin, but in a DeFi protocol. So these are the three main actors, and this being shown to be a very, very robust protocol. in the case of a crypto crash, for example, as in March. In March, you know, other protocol had very difficult days. For our protocol, it was a normal day, no problem. They only been liquidated, the BTCX been liquidated because the price of Bitcoin went down 50%. But that is expected. If you have a 2x leverage position and the price of your asset is down 50%, you are going to be liquidated. Nobody was surprised for that.
Teana, may I add something?
Please.
So as a Bitcoiner, what I love about money on chain is first that is non-KYC, fully non-custodian, and users can only go and get liquidity against a smart contract. So this is like, it's being built, you can tell that it's being built by Bitcoiners. But the second thing is that currently in Latin American countries such as Argentina and Venezuela, we have a huge amount of demand for stable coins on a peer-to-peer basis. So not only to hedge on exchanges for trading, but for peer-to-peer transactions. So every time a Bitcoiner buys BitPro or BTCX, it's not only making a passive income on their Bitcoin, but also enabling the construction of DeFi and a financial system built on top of Bitcoin. So this is what Manu was saying before, that is deeply rooted to the birth of RSK, and the reason why we built this, it's because these kind of use cases are much more needed in the emerging markets and around the world to create a financial system that includes everyone.
Well, tell us a little bit more, Gabriel, about the process of the merge mining RSK and how it leverages Bitcoin's proof of work security model. So, you know, how many miners or what percentage of the work are merge mining RSK, and how are they incentivized?
Yes, so the merge mining in RSK is connected at the mining pool level. So we developed the software, and several mining pools around the world implemented. I think as of today is 8 of the most important mining pools that have already implemented. The percentage varies because the hashing power in Bitcoin varies a lot. So it goes from 40% to 69, I think was the maximum. We are in the process of onboarding some new very important mining pools. And basically, so RSK fees generated when executing smart contracts, 80% of them go to the Bitcoin mining pools that they can distribute to the Bitcoin miners later. So we built RSK in such a way that it was a no-brainer for mining pools to integrate and get extra fees and income from smart contract execution. And this creates a virtuous cycle where miners get higher profitability and they can invest in more hardware and make Bitcoin more secure. So RSK has been designed in such a way that every single stakeholder benefits if RSK is successful. So Bitcoiners will see more Bitcoins being locked and higher Bitcoin price. Bitcoin miners are getting more fees, and Solidity, smart contracts, and DeFi platforms have an alternative to also secure their platforms with Bitcoin proof of work. So it's a win-win for everyone.
Yeah, it sounds like it. So, you know, with some of the issues that Ethereum Classic has encountered over the past few months, does RSK become the best or a natural option for Ethereum users that still believe that proof of work is the best security model? And do you think that the upcoming release of Ethereum 2.0 will impact your projects? I'll pose that to both of you.
Yeah, so it's quite interesting, no? It's super challenging for Ethereum to move to 2.0 and change completely the proof of work to proof of stake. And I know for a fact that many projects running only on Ethereum are quite concerned about how that will affect their projects. Sure. In that sense, RSK has been built following Satoshi's advice and way of seeing the world. So we believe in immutability and not rolling back a blockchain, but also not changing the rules and the proof of work for the projects deciding to build as money on chain on top of RSK. yeah, absolutely, RSK could be an option. It's an option now, and we don't see the world as you have to choose between one or the other. We believe that very important projects in the DeFi ecosystem should hedge themselves, should make sure that the projects and the users are safe regardless what happens at an infrastructure level. So we encourage every single project to use the bridge, to make their tokens and their services available in RSK to RSK and Bitcoin users. And regarding ETC, as I said before, we're working close to the team to see if there's anything that we can do from Bitcoin and from RSK to help the great teams building on ETC also. Because again, we believe that all these open source projects that are fully compatible, we are all working in the same direction. We are building these to serve billions of underserved and excluded users around the world. And the more the merrier, it's everything is open source. We help each other. We can merge our roadmaps. And this has been from day one our philosophy, working very close with other projects and trying to focus on the value that this technology is creating and not the technology itself.
Brilliant. I think you're also promoting an airdrop. So do you want to tell our viewers a little bit more about the airdrop, Manu?
Well, yes, we don't, it could be called an airdrop. It's more, what we want to do is to help people to learn DeFi for Bitcoin. So we are going to share a link afterwards for anybody who wants to use it. You need a code which is Coinscrum BPRO. So that's the code that you will need. And we will send the first 50 persons who wants to try DeFi for Bitcoin. We will send a little bit of BPRO, and then they will be able to exchange it for smart Bitcoins or dollar and chain or whatever. But the idea is just for people to be able to try it, to test it, to see that this is not science fiction, that anybody in the world can use it.
Both of you, Gabriel and Manu, thank you so much for joining us today. It's been a fascinating conversation and a pleasure to speak with you both.
You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.